How the IRS taxes retirement income. Navigating taxes in retirement can be challenging. Your tax situation may differ from your working years due to income and tax bracket changes. Required withdrawals from retirement accounts and income from other sources can also affect your tax liabilities. That's why it's important to know how common sources of retirement income are taxed. Having this information can help you develop a tax-efficient strategy for your retirement years. First, let's take a look at how some income in retirement is taxed. Social Security benefits. Depending on provisional income, up to 85% of Social Security benefits can be taxed by the IRS at ordinary income tax rates. Pensions. Pension payments are generally fully taxable as ordinary income unless you made after-tax contributions. Interest-bearing accounts. Interest payments are taxed at ordinary income rates, but municipal bond interest is exempt from federal tax and may be exempt from state tax. Sales of stocks, bonds, and mutual funds, long-term gains held over a year, are taxed at 0%, 15%, or 20% capital gains tax rates, based on income thresholds. Net investment income tax factors in for some taxpayers, at a rate of 3.8%. Dividends. Qualified dividends are taxed at long-term capital gains rates. Non-qualified dividends are taxed as ordinary income based on your federal tax bracket. Traditional IRAs and 401ks. Contributions to traditional IRAs and 401ks reduce your taxable income, but withdrawals are taxed at ordinary income rates. Required minimum distributions start at age 73. Withdrawals before age 59.5 are subject to a tax penalty. Roth IRAs and Roth 401ks. Contributions to Roth accounts are not tax deductible. Withdrawals after 5 years following the first contribution are tax-free for Roth IRAs, including gains. But withdrawals before age 59.5 are subject to a tax penalty. Life insurance proceeds. Life insurance proceeds are generally not subject to tax when received as a beneficiary. But surrendering a policy for cash may have tax implications. Savings bonds. Bond interest is generally taxable at ordinary income rates upon maturity or redemption but may be tax-free for education expenses if certain conditions are met. Annuities. For annuities, the portion representing the principal is tax-free. Earnings are taxed at ordinary income rates unless purchased with pre-tax funds. Home sales. Under the Section 121 home sale exclusion, primary home sale gains up to $250,000, $500,000 for married couples, are excluded from income tax if specific ownership and use criteria are met. Now let's look at the types of income the IRS doesn't tax. Financial gifts. Financial gifts are a well-known category of non-taxable income. That's due in part to the generous annual federal gift tax limit. For example, for the 2023 tax year, you could give up to $17,000 to friends, family, or anyone else and not be taxed. The recipients won't be taxed on that amount either. The gift tax limit for gifts given in 2024 has risen to $18,000. It is one of many IRS provisions that is adjusted annually for inflation. So you can give up to that amount to as many people as you want without incurring tax liability. For married couples, the 2024 limit is $18,000 each. Charitable gifts are generally non-taxable. Be sure to get receipts and ensure the charities you give to are legitimate. Unfortunately, gifts given by employers to employees that are akin to cash, for example, gift cards, are usually considered taxable by the IRS. However, some other employer-provided benefits and fringe benefits are not taxable. Examples include employer-provided health insurance, up to $50,000 of group term life insurance provided by your employer, and employer contributions to your health savings account, HSA, if you have one. Generally, distributions from your HSA for qualified medical expenses are tax-free, while HSA distributions used for other purposes are subject to an additional 20% tax penalty. If you are 65 or older, however, you can withdraw HSA funds for non-medical expenses without paying the additional tax penalty. But ordinary income tax rates still apply to distributions for other than qualified medical expenses. Inheritances. The IRS doesn't consider inheritances to be taxable income. That includes inheritances of cash, property, etc. Remember, though, that if the money you receive from an inheritance subsequently generates income, such as the interest from an interest-bearing account, those earnings may be taxable. Also, although there is no federal inheritance tax, some states tax inheritances. As of 2023, these states are Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. Iowa plans to fully phase out its inheritance tax by 2025. But few taxpayers overall pay state inheritance taxes due to varying exemptions. Life insurance proceeds. Life insurance policy proceeds received by a beneficiary after the policyholder's death are generally tax-free. But interest earned on the proceeds may be taxable, and tax rules can get complex if the policyholder surrenders the policy for cash. Also, if you take a life insurance policy loan, the loan generally isn't taxable as long as the policy remains in force and the loan amount doesn't exceed the amount of policy premiums paid. Annuities. Different types of annuities are subject to different tax treatments. Generally, you pay taxes on annuities only once you start receiving payments or withdrawing funds. For example, earnings from non-qualified annuities are taxed upon withdrawal, while the contributions from after-tax dollars are not taxed. Annuities are complex, so it's a good idea to seek advice from a trusted professional if you need clarification on your tax exposure. Long-term care insurance income. Payments received from long-term care insurance policies are usually not subject to tax. So, if you receive reimbursements for medical expenses due to injury or illness under an accident and health insurance contract, these payments are generally considered non-taxable by the IRS. Disability benefits. Disability and workers' compensation payments are generally non-taxable. Supplemental security income payments are also tax-exempt. Disability compensation or pension payments from the Department of Veterans Affairs to U.S. military veterans are tax-free as well. Municipal bond interest. Government-issued bond interest is mostly tax-exempt, but some municipal interest may be taxable at federal and state levels. For example, U.S. Treasury securities are taxable at the federal level. Corporate bond interest is taxable at both the federal and state levels. Some capital gains and losses. If your capital losses exceed your capital gains, you can claim up to $3,000 excess loss as a deduction from your income. The deduction amount is the lesser of $3,000, $1,500 if married filing separately, or the total net loss on Schedule D of your Form 1040. The IRS allows you to carry the loss forward to later years under specific rules. Also, if you meet certain criteria, you can avoid capital gains taxes on the first $250,000 for single filers, of your profits on the sale of your primary residence, and up to $500,000 if married and filing jointly. Roth account income. Qualified distributions. For example, from a Roth account at least 5 years old since you first contributed and when you are 59.5 years or older are tax-exempt. The IRS now allows you to make regular contributions to your Roth IRA at any age. Plus, you can leave any amount in your Roth IRA for as long as you live. Alimony and child support. If you receive alimony or maintenance payments as part of a separation or divorce agreement made on or after January 1, 2019, those payments are not taxable. On the other hand, if you are paying alimony under such an agreement, you cannot deduct the payments from your income tax. However, state tax treatment of alimony may differ. Child support payments are not subject to tax. Earned income in states with no income tax. If you live in one of the 9 states without personal income tax, Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. You won't be taxed on your earned income at the state level. But Washington state has introduced a capital gains tax, and New Hampshire is phasing out its interest and dividend income tax. Additionally, while some portion of your Social Security payments may be subject to federal tax, most states don't tax Social Security income. The bottom line. A frustrating thing about working hard to earn money is knowing the IRS will tax a portion of your earnings. Federal taxable income generally includes wages, tips, royalties, commissions, and for some, up to 85% of Social Security benefits. And that's not a complete list. Whether income is taxable or not depends on various rules, requirements, and regulations, or whether you're talking about federal or state taxes. To help navigate through it, it's always a good idea to consult with a trusted tax professional or financial advisor if you are uncertain about your tax burden and how to minimize it. Be sure to like and subscribe to catch the next video from New Day Property Redevelopers.